Welcome to my channel. I'm Scott, and in this video we're going to cover 5 airline stocks. The first is Gol Intelligent Airlines, then China Southern Airlines, Alaska Air, China Eastern Airlines, and last is Azul. The airline industry offers air transportation and travel services for individuals and cargo. Some of the main services offered are flight transport, aircraft leasing, hotel booking, and car rentals. As the surge of COVID-19 has subsided, many airlines have seen bookings grow at a fast pace. Unfortunately, the price of jet fuel has surged recently following Russia's invasion of Ukraine. The increase of oil prices may hurt the margins for the airline industry. There are some companies that fly all over the world, and then others just fly within a specific country, and then some companies just fly within a specific region of a country. Let's get started with the model. The first company we're going to look at is Gol Intelligent Airlines, and they're located in Brazil. Their latest financials are as of 3/31. They're a mid-cap company, $9.5 billion market cap. They're trading at $6 a share, and they have 1.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative free cash flow in 2021, mainly due to COVID, but it did bounce back. It was positive $44 million in the trailing 12 months. Free cash flow is the cash that's remaining for you, the investor. So a company can pay a dividend, buy back stock, pay down debt, or invest back into the business to grow it. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had a small positive in 2019, but a pretty big negative in 2020, and even bigger negative in 2021, and then it's getting a little better, negative $414 million in the trailing 12 months. Revenue is a sales for the company, and that's down 34% from 2019 to the trailing 12 months. But it has been growing since 2020. It went from 1.3 billion to 1.8 billion. The weighted average cost of capital is an important number in a DCF model. That's a number you discount the future cash flows by. Their WACC is really high according to Finbox, 14.5% to 17%. I took the middle number, 15.8%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 3.4 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $2.9 billion. We divide that by 1.6 billion shares. And we get a calculated stock price of 184. They're trading at 601, so they're trading at a 226% premium. It's a sell according to the model. The company's revenue target for 2024 is 19 billion reais. All their financials are reported in Brazilian reais. I converted the numbers to US dollars on my Excel spreadsheet since we're looking at the ticker that trades in the US. So 19 billion reais is 3.8 billion US dollars. And their revenue target in 2023 is $3.5 billion. In 2022, it's $2.9 billion. And I just continue this growth into 2025, and I got $4.1 billion. That's how I got their future revenue estimates. They convert 11% of their revenue in 2019 to free cash flow, so I multiplied their future revenue estimates by 11%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $31. They're saying it's 81% undervalued. 4 analysts priced this stock, and the average price target is $9.25. The low is 8, the high is 10. If you invested $10,000 into this company 10 years ago, you'd have $6,600 today. That's a 34% loss, or a 4% annual loss. This is where the stock has been trading the last 5 years. It was over $20 before COVID, but 5 years ago, it was trading at about $5. So if you did buy it 5 years ago, you'd be up right now. And it looks like it hit about $3 during the COVID crash. And the stock has come up to about $11 after COVID, but it's come back down in the past few months like most stocks have. The second company we're going to look at is China Southern Airlines. This is a large cap company, 14 billion market cap. They're trading at $26 a share. and they have 532 million shares outstanding. They did have a lot of free cash flow in 2019, but in 2018, 2020, and 2021, it's a pretty big negative. Net income was positive in 2018 and 2019, but negative in 2020 and 2021. Their revenue is down 29% from 2018 to 2021, but it has increased a little bit from 2020 to 2021. And their WACC on Finbox ranges from 8.5% to 9.8%. I use the middle one of 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 46 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $36 billion. We divide that by 532 million shares, and we get a calculated stock price of $67. They're trading at $26, so they're trading at a 62% discount. It's a buy according to the model. Their revenue target for 2024 is 178 billion Chinese yuan. When you convert that to US dollars, that's 27 billion. Their 2023 revenue target is 23 billion US dollars. 2022, 16 billion. And I projected their 2025 to be 30.5 billion. That's how I got their future revenue estimates. In 2019, they converted 10% of their revenue into free cash flow. So I multiplied their 2024 and 2025 revenue by 10%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow in 22 and 23. The website Simply Wall Street is really high on this one at 126. They're saying it's 80% undervalued. If you put $10,000 into this company 10 years ago, you'd have $13,000 today. That's a 31% return, a 3% annual return. This is where the stock has been trading the last 5 years. It was up to $70 back in the beginning of 2018. It looks like it dropped to $20 in the beginning of COVID. It almost hit $40 a year ago, but it has come back down quite a bit. It's not trading that much higher than it was at the COVID bottom. And it's trading at a huge discount to where it was trading pre-COVID levels. The third company we're going to look at is Alaska Air. This is a mid-cap company, 6 billion market cap. They're trading at $47 a share, and they have 126 million shares outstanding. Their free cash flow looks pretty good. They did have a negative in 2020, but a positive in the other years. Net income is the same, negative in 2020, positive in the other years. Revenue is only down 20% from 2019 to the trailing 12 months, and it has doubled from 2020 to the trailing 12 months. Their WACC on Finbox ranges from 7.8% to 9.5%. I used 8.8%, the middle one, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 20 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $18 billion. We divide that by 126 million shares. And we get a calculated stock price of 140. They're trading at 47, so they're trading at a 66% discount. It's a really strong buy according to the model. Their revenue target for 2024 is 10.9 billion. For 2023, it's 10.2 billion. For 2022, it's 9.3 billion. And then I continued this growth into 2025, and I got 11.6 billion. That's how I got their future revenue estimates. In 2019, 2020, and the trailing 12 months, they convert on average 11% of their revenue into free cash flow. So I multiplied their future revenue estimates by 11%. That's how I got their future free cash flows. Although for 2022, I didn't grow it by 11%. I grew it by half of that, 5.5%, just to be conservative. The website Simply Wall Street is really low on this one. Their valuation is $6. They're saying it's 700% overvalued. 9 analysts priced this stock, and the average price target is 77, the lowest 59, the highest 103. If you put $10,000 into this company 10 years ago, you'd have $32,000 today. That's a 219% return, a 12% annual return. This is where the stock has been trading the last 5 years. In the middle of 2017, it was over $90 a share. And then it looks like it bottomed out at about 25 during the COVID crash. It broke through 70, but now it's come back down below 50. The fourth company we're going to look at is China Eastern Airlines. This is a large cap company, 11.5 billion market cap. They're trading at $17 a share. and they have 676 million shares outstanding. They had lots of free cash flow in 2019, but it's been negative since then. Same thing with their net income, positive in 2019, but big negatives after that. Their revenue is down 45% from 2019 to the trailing 12 months, and it's down slightly from 2021 to the trailing 12 months. Their WACC on Finbox ranges from 8.5% to 9.8%. I use the middle one of 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $69 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $53 billion. We divide that by 676 million shares, and we get a calculated stock price of $79. They're trading at $17, so they're trading at a 78% discount. It's a really strong buy according to the model. Their revenue target for 2024 is 146 billion Chinese yuan. When you convert that to US dollars, that's 22 billion. Their 2023 revenue target is 18 billion, 2022 is 14 billion, and my forecast for 2025 is 25.7 billion. That's how I got their future revenue estimates. In 2019, they converted 18% of their revenue into free cash flow, so I multiplied their 2024 and 2025 revenue by 18%. That's how I got their future free cash flows. And I assumed it would be negative in 22 and 23. The website Simply Wall Street values the company at $40. They're saying it's 59% undervalued. If you invested $10,000 into this company 10 years ago, you'd have $11,400 today. That's a 14% return, a 1.3% annual return. This is where the stock has been trading the last 5 years. So it looks like it's trading at its lowest level, at least since 2017, even lower than the COVID bottom. And the stock was almost $45 a share at its peak just back in 2018. So it's trading at a huge discount. The last airline we're going to look at is the Brazilian company Azul. This is a small cap company, 1.5 billion market cap. They're trading at $13 a share, and they have 116 million shares outstanding. They had positive free cash flow in 2019 and 2020. But negative in 2021 and the trailing 12 months. Their net income is negative each year, except in the trailing 12 months, it is positive 220 million. Their revenue is down the least of all the airline companies we looked at. It's only down 1% from 2019 to the trailing 12 months. It doubled from 2020 to the trailing 12 months. Their WACC on Simply Wall Street ranges from 17.3% to 20.3%. I use the middle of 18.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 2.4 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 116 million shares, and we get a calculated stock price of $15. They're trading at $13, so they're trading at a 13% discount. It's a buy according to the model. Their 2024 revenue is projected to be 19.3 billion reais. When you convert that to US dollars, it's 3.9 billion. Their revenue target for 2023 is 3.6 billion. For 2022, it's 3 billion. And I forecasted 4.1 billion for 2025. That's how I got their future revenue estimates. In 2019 and 2020, they converted on average 9% of their revenue into free cash flow. So I multiplied their future revenue estimates by 9%. That's how I got their future free cash flows. Although I did give them a negative free cash flow in 2022 to try to be conservative. The website Simply Wall Street values them at $16. They're saying it's 22% undervalued. 5 analysts priced this stock, and the average price target is 21, the lowest 17, the highest 25. If you invested $10,000 into this company when they started trading in 2017, you'd be at $6,000 today. That's a 41% loss, a 10% annual loss. This is where the stock has been trading the last 5 years. It was over $20 right before COVID. Then it got really low. It looks like it might have touched $5. It came up to about $28, but it's been cut in half since then. Here's all 5 company stock prices the past 5 years. You can see Gol does its own thing. It's up 29% in the past 5 years. But the other 4 stocks pretty much track each other. They're all down around 40%. There are 22 stocks that trade in the airline industry, And the 5 stocks we looked at are highlighted in green. If they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So both Chinese companies spend more in CapEx than the average. The other 3 companies spend less in CapEx. And most airlines are pretty leveraged. China Eastern's debt to equity ratio is 3.6. That means for every dollar of equity, they have $3.60 of debt. We can't look at Gol or Azul since they have negative equity. And Alaska is doing well in that category, only 1.1. Only Alaska and Gol have positive free cash flow of the 5 companies we looked at. The other 3 have negative. China Southern is the largest company we looked at. Azul is the smallest company. Both Chinese companies have a better price to book than average. Alaska is also better than average. The 2 Brazilian companies have negative equity, so we can't look at the price to book. Azul has the best PE at 6.9, Alaska is 12.7, and we can't look at the other 3 companies since they have negative earnings. Alaska is the only company that has a good price to free cash flow. Gol has the worst price to sales than average, but the other 4 are better than average. Both Chinese companies generate more revenue than average, the other 3 companies are less. The average airline company has an 8% decline in revenue in the past 3 years. Azul is one of the few companies that has a positive. Alaska is negative, but it's still better than the average. So to summarize, of the 5 companies we looked at, I have one overvalued Gol and the others undervalued. The analysts have 3 undervalued, and I couldn't find price targets on the 2 Chinese companies. Simply Wall Street has Alaska really overvalued, but the other 4 undervalued. The airline industry is a tough industry to make money in, but these stocks have gotten beaten down so much, they could be a really good buy at this point. Because airlines will always be around. There may be new companies, but the airline industry will always be really important in order for our society to function. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.